So good morning everybody. Good morning. As earlier we have discussed that in today's lecture we will try to start about the functions of finance. And in the previous lecture we have discussed that functions of finance we are going to take up with respect to three decisions: financing decision, investment decision and dividend decision. In the previous few lectures, or we can say in the last lecture, we have discussed about the sources of finance. In today's lecture we will take up another aspect of financing decision, and the topic will be leverage. Before discussing about the leverage, we are supposed to discuss what we understand by capital structure. Because when we talk about finance, that means the company is supposed to generate the fund. Financing decision means in two aspects: how much fund is required, and number two, who will be the various sources. And when we talk about the various sources, then we have to take a decision what should be the mix of these sources. That means few questions are always advised that we are supposed to respond when we are trying to discuss or we are trying to construct the capital structure of the company. As I said, first point will be what is the total amount that we are supposed to generate as fund. And secondly, what should be the mix of that fund. And thirdly, what will be the impact of that mix on the value of the fund. As I said, the first, in which we said the total amount of fund required, that will be given by investment decision. Because whatever the investment that we are having, that investment amount is going to suggest that what should be the fund that we are supposed to generate. So the first point will be satisfied with the help of investment decision. But the second point and the third point, that means in second point we said that what should be the mix of these sources. And when we talk about the mix, we have the mixed sources in the form of equity and debts. That means how much equity is supposed to be financed and how much debt is supposed to be financed. And when we are able to take a decision regarding the equity as well as debts, then we try to take up the decision that what will be the impact on the value of the firm. How much equity? Impact on the value of the firm. How much debt? Impact on the value of the firm. When we say impact on the value of the firm means earning to the shareholder, risk to the shareholder. In these two aspects we try to calculate the value. Now when we talk about the mix, as I said, it can be in the form of debts and equity. Equity means generating fund by making issue of equity share capital, number one. Preference share capital, share premium, reserve and surplus. This is the formation of equity. And when we say debts, then in debts we can include all long-term finance, long-term debts. That means borrowing, debentures, bonds and long-term borrowing. As you are also aware that whatever the equity that we are financing, the company has to meet the promise to the equity shareholder in the form of dividend. And whatever the debts that we are trying to finance, the company has to meet their promise in the form of interest. That means debt holders, they are going to provide the fund to the company against the interest, and equity shareholders, they will provide the fund for providing their amount, for getting the amount of share in the profit in the form of dividend. As we are trying to discuss about capital structure, so one thing I will like to clear, that there is a difference between financial structure and capital structure. When we say financial structure, it includes non-current liability and current liability both. But when we say capital structure, it do not include the current liability. It only includes the non-current liability. That means when we say financial structure, it means equity, preference, share premium, reserve and surplus, and the various long-term debts. But when we say financial structure, along with these, we include current liabilities also. So here we are not trying to discuss about the financial structure of the company, but we are trying to discuss about the capital structure of the company. Because long-term financing. So the question arises is that what should be the mix? Means if the company wants, then company can generate the fund. If the company wants, the company can generate the fund by making the issue of shares only. Or company can make the issue of debts only. Means what I am trying to say, if the company has the requirement of 100 crores as capital, then company can adopt only one source and they can generate the fund if the company has reputation in the market. If the company is big, they can issue 100 crores of equity share and they are able to generate the fund. Or they can make the issue of bonds of 100 crores and they can get the fund. But there are some merits and demerits with shares and debts. Like when we invite the capital through only shares, it means the company do not have the liability of making the payment of dividend. If the profit will be there, then the dividend will be paid. And if the profit is not there, no accountability, no liability on the company. But when the company invite the capital through debts, then the company is supposed to make the payment of interest. That means if the interest is not paid, then it will be a red sign for the company. That means all the debt holders, they are interested in getting the amount of interest on the yearly basis. That means whatever the amount of capital the company has invited in the form of debts, the return should always be greater than the interest amount of the debt financing. That means if the company do not generate any profit, then also the interest has to be paid. So debts have a drawback. That interest amount will be constant, whether the profit is there or profit is not there. But debt also has advantage. The amount of interest the company is going to make the payment, that interest is going to help in reducing the tax liability. As we have discussed in the previous lecture, that interest and depreciation, they help in reducing the tax liability. So debts, they have the advantage that tax liability will be saved. But in share, tax liability is not saved. That means the company plan that they should invite the capital from two sources. Because the company want the benefit from both the sources. Company want the benefit of no accountability and company want the benefit of saving the tax liability. So company think that they should prepare a mix of shares and debts for inviting the capital structure. Number of tools and techniques are available in the market with the help of which the company can take the decision that what should be the optimum capital structure, or we can say the mix of financing. But there are two techniques that we are using. The first is known as leverage and other is known as EBIT EPS analysis. Means I am saying the first is leverage and second is EBIT EPS analysis. These are the two techniques. These are the two techniques for deciding the optimum capital structure. In today's lecture, we will try to take up the first aspect, that is the first technique, that is leverage. That although the topic was leverage, but we are supposed to take up that from where we have arrived the topic as leverage. So as the company is supposed to construct the capital structure, deciding the total amount of fund to be generated, deciding what should be the mix, and deciding what will be the impact on the value of the firm, all these three decisions will be taken care with the help of these two techniques. That is leverage and EBIT EPS. EBIT means earning before interest and taxes. Earning before interest and taxes, and EPS is earning per share. So in today's lecture, leverage will be there. Leverage, very important aspect. Leverage, basically, if we try to define, it is trying to help us in knowing the employability of the assets of the company. That means whatever the fixed assets the company is engaging in the project, what the return the company is getting from those fixed assets. Means leverage is a very important aspect because it helps the company in knowing the return in terms of turnover or times, as well as also help us in knowing the relationship between the variables, as well as also help us in knowing the amount of risk existing in the company. As I said, that whatever the project that we have in our mind, all those projects, they are being handled with the help of long-term assets. That means company has to generate long-term finance. Company has to generate long-term finance for purchasing or engaging long-term assets in the company for the investment proposal. That means all these long-term, they will also be having the fixed cost. All these long-term, they will be having their fixed cost. So leverage will help us in knowing that what is the we can say overall profitability of the company after meeting out the fixed cost as well. Leverage helps us in knowing the relationship between the variables. It helps us in knowing the relationship between the variables. It do not measure the variable. Mind it. It is not measuring the variable, but it is measuring the relationship between the variables. And when we talk what we mean by variables, or when we say relationship, it means among the two variables, one should be dependent and other should be independent. Because two dependent and two independent, they will not draw any relation. Relation will always be drawn if the variables engaged are dependent and independent both. When we talk about variables, what are variables? Sales is a variable. Variable cost is a variable. Fixed cost is a variable. Interest amount, it is a variable. That means interest, taxes, depreciation, variable cost, fixed cost, sales, earning per share, all these are variables. Means we want to see that if the cost is increased, what is the impact on the profit? If the sale is increased, what is the impact on the profit? If the interest is decreased, what will be the impact on the earnings? That means ultimately that whatever the various variables are there, we are trying to develop the relationship between the variables. I will try to draw a cost structure, and with the help of that cost structure you can easily know that how to calculate or measure the relationship between these variables. Like, as you are aware that the company has sale. From the sale, V minus variable cost. Whatever is left is known as contribution. That means sales minus variable cost is contribution. We deduct the fixed cost, and whatever we get is known as EBIT, earning before interest and taxes. If you try to see this phase, sale, that means it included the production activity. The output has been received, but this output has been received by making the involvement of variable cost, making the involvement of fixed cost. And when we say fixed cost, you can say depreciation, you can say salary, and you can say other expenses which are in the fixed form, like the rent of the premises. All these are fixed. That means from the sale, variable will be recovered, from the sale, fixed will be recovered, and the remaining portion will be known as the profit, or you can say earning of the company. So this portion is basically, we can say, operation of the company, means operation of the company. Then you have EBIT. EBIT is left out as a residual. We minus the interest. Interest amount, that means the interest that we have promised to the various debt holders. सारे खर्चे माइनस कर दिए, अब इंटरेस्ट माइनस कर दिया. Whatever is left is known as profit before tax. Profit before tax. One more liability that is having on the company head is the payment to the government in the form of tax. We minus the tax. We minus the tax and we left with profit after tax. Profit after tax. And from this profit after tax, we divide number of shares. जितना भी प्रॉफिट बचा है उसको नंबर ऑफ शेयर्स से हम डिवाइड करते हैं एंड वी गेट अर्निंग पर शेयर. That means the variables are sales, fixed cost, EBIT, variable cost, depreciation, salary, rent, taxes, interest, all these are variables, and EPS. That means what we are doing, we are trying to know that what will be the impact of increase or decrease in sale. If there is increase or decrease in sale, what will be the impact on the earning of our owner? They are the shareholder. That means either it is going to increase or it is decreasing. That means we want to know the return as well as the risk portion. If we are inviting, that means the amount of capital that we have drawn, or the amount of capital we have brought in the form of equity, if suppose only in the form of equity, then what will be the impact on EPS? Only on debts, what will be the impact on EPS? And if we are having the mix of equity and this debt, then what will be the impact on the EPS?